this is a business, and you want to try to figure out what the risks are and mitigate those risks. So you want to protect against the downside. And then as long as you're disciplined with your underwriting and know that you've got some upside, like that's what you should do, right? Protect
Yeah.
the downside and let the upside, it can't really take care of itself, but you've got to protect those downside risks. And debt is the number one thing that if there's ever a real estate, I don't want to say crash, but if there's trouble in the real estate market, it's always debt related.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome everyone to Decoding Cash Flow. Today we have an amazing guest, Ken Gee. Ken is a founder and managing member of KRI Partners, a real estate, private equity, and investor education firm. It's great to have a seasoned multifamily investors like Ken on the show, who has more than 26 years of real estate experience and has been involved in transactions valued more than $2 billion. So Ken, welcome to Decoding Cash Flow. It's a pleasure having you here.
Well, thanks for having me. It's a pleasure to be here for sure.
All right. So Ken, before we dive deep into your multifamily strategies, your niche, can you give our listeners a little bit background about yourself? What did you do before you got started in real estate, and how did you come to real estate?
Yeah. So grew up in Toledo, Ohio. Most people don't even know where that is. If you watched MASH on TV, that just I dated me, but you would know Toledo from Max Klinger and Tony Packo's hot dogs. But anyway, got my undergrad at University of Toledo, moved to Cleveland, became a commercial lender, spent 5 years as a commercial lender with a regional bank, and went to school at night at Case Western Reserve University, small private school, and became a CPA. Left the bank. What happened was all my customers at the bank, I wanted to, hey, you should do this. Hey, you should think about that. And, their response was, I'll talk to my CPA. I'm like, come on, man. I said, all right, well, then I'll go be a CPA. So that's what I did. I went to school, got the CPA, worked for Deloitte for 7 years on the tax side, did a lot of merger and acquisition work, private equity work, due diligence, all the stuff that now fast forward in my life was massively helpful. I didn't obviously understand that at the time. So it was there that, what happened was, my kids were very young. My daughter had just been born. I would do the middle of the night feeding with her at 3 a.m. And it was cool. I don't know if you have a daughter, but if you do, that's a really cool time that you can spend with your daughter. It's a bond that's really special, right?
Yeah, I got two boys.
It is, yeah. Oh, you have two boys. Okay, all right.
Yeah,
okay.
a little, yeah.
So it was, I enjoyed the time, right? It was just her and I, 3 a.m, nobody bothering us. The problem was, I realized after a while that, wait a minute, Ken, you dope. This is 3 a.m. and this is the best you're doing with your daughter and your family. And that got me thinking, man, this is not right. I thought I did everything right. I went to school, got good grades, got a good job, did everything the standard stuff that you were taught back then. And I realized that my family is now going to probably grow up without me, because I was working like a dog at Deloitte, and that just bummed me out. I didn't want to miss my family's life. So I said, all right, I had a lot of clients at a bank that were into real estate. The tax practice at Deloitte was massive real estate practice, just all the big ones. And I see these people making tons of money left and right. And I thought, I got to figure this thing out, because I really think it'll change my life, because it certainly has impacted those people, right? So I spent about 1.5 years trying to figure out the business. There were not good podcasts like this back then. I bought a Carlton Sheets no down payment system, which is cassette tapes I used to put in my car. I used to go to apartment association meetings, try to figure it out. And so I bought 3 small deals. I bought like a 28 unit, 22, and a 24 unit. Sold them 3 years later, made $500,000. Now, this was on the side, right? I was still at Deloitte at the time. And I thought, oh my goodness, are you serious? Like, it blew my mind. Like, who makes $500,000 on the side? And from then I was like, you know what? I wasn't wrong. I proved the model now. Now I need to stick with this and do this. And that's exactly what I've done for, 26 years. 27 years now, actually.
That's really great. And what I heard from you is, that was the pivotal moment, right? When you were spending time with your daughter, and
Hmm.
you just said, why I'm working so hard. I'm just trading time for money.
Yeah.
And how can I get out of this, golden handcuff that you had with Delight?
That's
And,
right. Yeah.
that's it. And you just started the side hustle, try to learn
Yeah.
the game, and then once you had a full control on what you're doing, in and out, you just quit Delight and were full time in the real estate,
That's right.
right?
Yeah. Yeah. Now, the good news is, fast forward 27 years, I got to go all of my daughter's basketball games, my son's baseball games. I got to see all their school stuff. I got to spend a lot of time with them. So I'll tell you, it worked. I'm thrilled that I did it, and I'm obviously thrilled because my quality of life is much better than it would have been. Nothing wrong with Deloitte. All right, I don't want you to think
Yeah.
that Deloitte is a bad
Mhm.
place. It's actually a fantastic place to work,
Yeah.
but I wouldn't have been able to do all those things if
Yeah.
I was a
And
CPA.
I think the other thing that you mentioned, right, at Deloitte, you were handling the merger and acquisition divisions, private equities part of say, and it might have helped you a lot while in the real estate aspect also. Am I
Oh,
right?
it's massively helpful.
Yeah.
Oh yeah, I mean looking back, it's like I could pretend like I was doing all these things in preparation for, but there was no chance it was that well planned. I mean, 5 years
Mhm.
as a commercial lender, right? What do we do
Yeah.
with real estate? We borrow all the time. It's really good to understand how lenders think, right? And
Yeah.
then the CPA thing, I mean, it's just all has really lent itself well
Yeah.
to the career that I chose, that I've ended up with.
Hmm. And that was like 26 years ago. That's what you're saying?
Yeah,
You started
1997 is the when I bought my
99.
first building.
About
Yeah.
that. Yeah. Yeah.
Hmm.
And what the first investment that you did, was it you alone or did you do it with the partners?
Yeah, great question. So I'm not telling anybody else to do this, but I borrowed my half of the down payment on my home equity line, and I went in my with my then in-laws, and they were my 50-50 partners. They were kind enough to, trust me, and they figured, you know
Mhm.
what, this guy seems okay. He'll work hard. We know where he lives. If he screws it all up, and they trusted me on my first deal. My
Okay.
second and third, I did on my own, because I was able to finance them a lot smarter. But that first deal, I did with my in-laws.
Mhm.
It's a bad first deal. I always tell everybody, you got to get that first deal. It's got to be a good deal, and if it is, you're off to the races. If it's not,
Yeah.
probably not coming back.
Yeah. It's like the first impression is the last impression, right? That's what the
Hmm.
saying is. So it,
Yeah.
it goes here also. Yeah.
No, you're not wrong. That's
Yeah.
exactly right. Yep.
Mm. Yeah. So before you invested in your first deal, right? As you know, as you said, there weren't no podcasts, there weren't no
Oh, no.
that maybe very few meetings or conferences related to real estate at that point of
Right.
time, if I hear it. All right, it might be just reading the books. Maybe there wasn't much material on the internet, also, right?
Right. No, there wasn't.
Online, yeah.
You know where I learned? I went to apartment association meetings.
Okay.
So they would have like a rental owners course, right? Where they would put on a course to teach people about real estate.
Hmm.
And so I would go. They were just insanely boring, but I took the time to network with whoever is lecturing that day.
Hmm.
And you had somebody that owned a bunch of properties. I would network with that person and the next
Yeah.
person, and that's how I learned. I mean, it was a very long, tough process. Oh my goodness, if I had all the resources that are out there today, wow,
Yeah.
I just feel like it would have been so accelerated.
That's good. Yeah. So fast forward to today, the current,
Mhm.
so as you mentioned, you're in multifamily. So
Yep.
what are the different areas that you invest in multifamily right now?
Yeah. So I'll fill in the blanks here. So I did for the first 10 years, we operated in Cleveland, mostly
Okay.
with our own money. We didn't really raise any outside money. And about syndicate one deal in Cleveland. And about 15 years ago, I thought, man, we're doing pretty well in Cleveland. Cleveland's a tough market. It's nothing wrong with the city. It's just
Mhm.
not growing, right?
Mhm.
So I thought, what if we did this in a place where people really wanted to live, right? Like Florida. Like
Yeah.
a lot of people want to live in Florida.
Yeah.
So 15 years ago, I said, all right, let's go do this. Let's go figure this out. So we started syndicating. I
Okay.
syndicated, you go find the deal, raise the money, close the deal. And we did a number of those deals. But what happened is, right, Florida is hyper competitive on the buy side.
Yeah. Yeah.
And, if there's one offer, there's 20. So now
Hmm.
here I am trying to set myself apart from all the other syndicators. And there's only one way to do it was price. So I had to pay up every time. Now we still did really well. But what happened was I eventually, now I'm just giving you the way the company has
Hmm.
matured.
Hmm.
Eventually I said, you know what, this is ridiculous. I don't want to keep doing this way. Raising 3, 4, $5 million in 45 days. I mean, that's massively stressful.
Yeah.
So I said, let's remember I had some private equity background from my
Hmm.
Deloitte days. I said, let's go raise the money first and then go buy the deal.
Okay.
And everybody's like, oh, no, that'll never work. Your syndication clients will never file. Everybody always tells you nothing will ever work. That's just what they
Hmm.
do. I ignored them and raised fund one, fund two, fund three. We're on fund four now. Guess what? It works. I mean, if
Hmm.
you can raise the money first, especially in the market that we're in right now, we've got $15 million that we're here to deploy in fund number four. And that's a lot of money to deploy. And so now when we bid against the syndicator,
Hmm.
it's kind of easy, right? Because I
Yeah.
already raised the money, Mr. Seller. You don't even need to worry about me. And so we're just at a huge advantage now on the buy side. Having said that, there's not a lot of deals out there right now.
Hmm.
But that's the model that we follow. It's harder to raise money that way because people have to really trust you to just write you a
Yeah.
blank check.
Yeah.
But what's really important is that we get way better deals than we would have.
Yeah. And you might also disclose to the buyer as well as the broker that you have the fund model and the money is ready to get deployed,
Oh,
right?
of
If the
course.
yeah.
Oh,
So
absolutely.
yeah,
Yeah.
so that gives you an advantage over the others who are still in the more syndication model seeking for money. There's no risk on, what if you're not able to raise enough money?
hmm
So
Already
yeah.
raised the money. Yeah,
Mhm.
it's that risk is off the table.
Yeah.
Yeah. And
And
plus, it's harder to raise money. So most people that run funds like we do, I mean,
mhm,
we've done now 19 deals. We've taken 14 of those full cycle and made
mhm,
money. It's all our full track records on our website. But the point is that it's harder, right? And those people that do funds almost always have more experience. So I mean, plus when you've closed with brokers in Florida, they get to know who you are and they trust you, right?
yeah.
They're like, okay, we know what Ken does. We know he's not going to jerk us around, all that kind of stuff. So that
Yeah.
coupled with the fact that he's already raised the money, now it's a
Mhm,
no-brainer.
yeah. And I think the other thing is, before you start a fund, the people need when you start a fund, the blank fund, the one that you mentioned, right?
The
People
blind pool,
needs
yeah.
they are investing in you and your company. They're not
That's
investing in the
right.
property, right? So you
That's
need
right.
to have enough experience
Yeah,
to get that trust, build the trust. And to get that experience, you have to start somewhere, maybe syndication. And
that's
after
right.
doing a couple of
Yep.
syndications, you go to the fund model,
hmm
right?
Yeah, I think before we raised our first fund, we probably done 5 or 6 syndicate. I don't remember now, probably five or
Mhm.
six syndications and
Yeah.
owned probably 10 properties. I don't remember now, but well, I mean, we've been at it. We were at it for at least 10, 11 years, right? We
Mhm.
didn't start out syndicating
Yeah.
because I just didn't feel comfortable taking your money if I didn't feel like I really knew what I was doing, right? I mean, I'm learning
Yeah.
every day. You never really feel like you really have it
Yeah.
all
That's
figured
right.
out, but it's better than, I've never done a deal before. Hey, would you like to invest with me? Like that's a hard sell, right?
Yeah, that's a hard
Me, it
sell.
is.
Mhm. And when you look for the properties, the multifamilies, what are the
Mhm.
specific criterias you have in mind? Okay, this is the location.
Yeah.
It needs to be type A, B, C,
Yeah.
class, whatever it is.
Yeah.
It needs to be certain units. What are the different criterias
Yeah.
you have in mind?
So the first thing, it's got to be in a good neighborhood. It's
Hmm.
got to be in a market that has diverse demand drivers. Like I love the military. I love people. Thank God for the military because we wouldn't be able to sit here and do what we do.
Hmm.
I don't want to buy next to a military base because I'm almost 100% dependent on one source, and that's
One,
a bad
yeah.
idea. So we like diverse demand drivers. We want a growing area. So good neighborhood, good diverse set of demand drivers. The area is growing, right? I'm trying to stack all the
Mhm.
things in my favor. And now we're looking for anywhere from 75 to 250 units.
Okay.
Doesn't matter. It's going to be higher quality assets. What you'll find is the longer people are in this business, the more they don't want to deal with the older products anymore. Been there, done
Mhm.
that. It's no fun.
Yeah.
So we tend to stay in the AB area in
Okay.
terms of asset classes.
Hmm.
Um, and when we do that, here's the important part. You need to have some upside in the deal. You have
Hmm.
to know that there's some upside there.
Yeah.
And so we know that if we can go in, meet all these criteria, get close to even leverage, and have $200 to $300 in upside, we know we're going to hit our goals, right? We just know that math works. That we're going to shoot, we're our target. It will hit our target of mid-teens annual returns and a 6% cash on cash.
Hmm. Okay. All right. And any specific strategies, or I would say, thumb rules that you use to underwrite these properties?
Yeah, I mean the biggest important rule that I want everybody to follow, not just us,
Hmm.
is number one, don't get FOMO. Don't get the fear of missing
Yeah.
out. We've seen that way too many times. Number
Yeah.
one. Number two, you don't negotiate your discipline. Underwrite the deal the right way with details, right? Don't just
Yeah.
high level it, because especially when you're starting out, you can't guess at these numbers. So underwrite it legitimately, and whatever it is, right?
Hmm.
Don't get pulled, don't get stretched. That's the key. So that's our discipline is what has really, I think, made us more successful. Now, has it slowed down our deal flow? It has, no
Yeah.
question about it. But I don't want to see that's when you get money in advance, everybody has to know that I'm going to have that discipline. Like if
Yeah.
I don't do another deal, that's okay. I'm not going to starve to death, right? And you need to have that level of
Yeah.
discipline when you're taking people's money and you're the one making the decision about what deal to put them in.
Yeah.
That makes sense.
No, absolutely. You always have to have a conservative underwriting process in place. It's
Yeah,
always about, uh, under promising, over delivering.
there you go.
Every time you put a deal together.
Hmm.
Uh, yeah,
Agree 100%. Yeah, but that's the thing that people, I don't know, man. The thing that gets most people is the FOMO. Because they're
that's
hearing, oh
true.
my gosh, you
Especially,
got a deal and you got a deal, and man, I don't have a deal yet. What am I going to do? Just wait. Don't worry about it. Just
yeah.
keep looking at deals and you'll find one.
Hmm.
But it's hard. It's really hard
Yeah,
for people. I
yeah,
I get it, because if you haven't done them before, you're like, I'm never going to get a deal. Yeah, you will. Just keep looking.
yeah. And after some time, I've seen, people try to stretch their numbers here and there just to
Yeah,
just to make it look good. But that's a pitfall. You never do that, because it's only one deal which will take you down.
that's right.
Yeah,
You're not wrong. Yeah,
yeah.
you're exactly right. So yeah, we want, especially their first deal, right? So um, when we help people figure out this business on the education side of what we do, my
Uh-huh.
goal for them is to make $1 million on a deal. Because if I can help them find a way to make $1 million on a deal, guess what? I've changed their whole entire life, right?
Hmm.
Do you
Yeah.
agree? Well, for most people,
Absolutely,
$1 million
absolutely. Yeah,
changes everything.
yeah. And
Yeah,
that's
and that
that's
that's
a first starting point too, right? And then once they make it, they will never look back.
that's right. Yeah, no, you're right.
Yeah.
Yep, I agree.
So, as you mentioned, on the educational side, uh,
Hmm.
you also have you personally educate people on
Yeah.
how to invest in multifamilies.
Yeah. So the way our company is structured is
Mhm.
we help people create wealth through real estate. So now the
Yeah.
question is, how do you want to do it? Do you want to do
Mhm.
your own deals, or do you want to invest passively and let us do all the work?
Okay.
Most people actually do both, because even if you're a passive investor, it's always good to understand the business you're investing in. So a lot of
Mhm.
people do both. So then on our education side, we start off with the numbers. You got to know the numbers first. That's the CPA in me. But what happens as soon as you understand the numbers, your confidence level just like goes through the roof. And then we
Mhm.
have what we call our advanced multifamily acquisition program. It basically takes them through every step of the way. Even like, I want to know, what are your strengths? What are your weaknesses? Let's figure out a
Mhm.
business plan that works for you. Let us help you do your personal financial statement, your real estate bio, so that when you talk to brokers, you're talking about the right things.
Yeah, using the
Figure out
right
a bit.
keywords. Yeah.
Yeah, yeah. I
Yeah.
mean, we even talk about that little elevator pitch. So what do
Yeah.
they say? What are you looking for, Ken? Yeah, we want them to know what to say, because you know what
Yeah.
happens if you don't. you go into bad broker bucket, and then they never call you back.
Yeah, that
So
one.
then we walk them through how to find the deals, how to talk to the brokers, how to do the LOI. And then so what you're seeing me do here is every single thing that we do when we do a deal, we teach them
Okay.
exactly what we do, because if you do it the way we do it, I'm like, we've proven our model works.
Yeah, that's great. All right. Now coming back to the strategies that you use in your company, right? We talked about strategies to select the property, underwrite, a brief underwriting the property. What about the financing aspect of it?
Yeah.
What type of loans do you use? What is the LTV ratio? Just if you can spend a few minutes on that,
Yeah.
please.
Yeah, absolutely. So remember, if you do the math on how long I've been doing this, I lived through 2008 and 2009. So I know what happens if you're not careful with your debt.
Yeah.
And we're seeing it now that people didn't understand how to manage debt properly, and they're in a bad place now, right?
Yeah.
So I would much rather, so we generally stick to longer term fixed rate financing. So
Okay.
I love the 7-year loans. Even let's say I'm going to buy a property and I'm going to add some value. I'm still going to put a 7-year loan on it, because if I'm doing a value add quick turn, they can put a supplemental on top of my loan,
Yeah.
and I can still sell it. I have flexibility there, right?
Yeah.
But what happens if, I have this is what happened to people that they're running into trouble now. They had a 3-year business plan. They put the bridge loan in place. They have a rate cap in place. Everything matches up. But what happens if they can't sell their property in 3 years? They're toast, because the rate cap expires. Interest rates went through the roof. So what we do is I would rather be forced to hold a property a little bit longer and be safe with that fixed rate. So we tend to like fixed rate agency debt. That's what we prefer, 7-year stuff. Sometimes we'll go to 10 years, but not usually. So what I want to do, and everything that we've always done, and this would be good for your listeners, when you're going, this is a business, and you want to try to figure out what the risks are and mitigate those risks. So you want to protect against the downside. And then as long as you're disciplined with your underwriting and know that you've got some upside, like that's what you should do, right? Protect the downside and let the upside, it can't really take care of itself, but you've got to protect those downside risks. And debt is the number one thing that if there's ever a real estate, I don't want to say crash, but if there's trouble in the real estate market, it's always debt related. It is. It just is. Right? It happened in 2008, 2009. It's happening right now. So that's why you want to really make sure you manage your debt. So that's what we do. We tend to stay away from HUD loans. We've done CMBS. It's just, the rates, they're not very competitive right now. We have done just a very little bit of bridge loans, but we tend to fix our rates. Like we have a bridge loan in place right now that was fixed for 5 years.
Okay.
See, that protected. I like that.
Yeah. And of course, as you mentioned, in the current scenario, like recently, the people who had the short-term loans, they are underwater after this interest rate went up. Had to refinance, and the cap rate are,
it's not pretty,
not that promising. Yeah.
Yeah, no, it's not pretty. And you asked about loan to value. I would say most loans right now are in the 65% range. I mean, that's just their debt coverage limited loans, right? It's based on the cash flow of the property. It's not, I can't remember the last time I heard somebody to say their loan was limited by loan to value restrictions. It's most of the time it's debt coverage ratio.
Yeah, similar, like, we here in New Jersey, we do ground up construction for luxury single family homes and small multifamily properties.
Ooh,
so, yeah. So we see the similar, debt coverage ratio, as you mentioned, for the new construction projects too.
Yeah. Now, I'd be curious how you protect yourself with the construction loans. Is it through rate caps?
Our construction loan, it's interest only.
Oh, yeah.
Right?
Okay.
Yeah.
Got it.
So, So once the construction is over, we always refinance with the same, either the same bank or somewhere else. Yeah.
Awesome. Okay. All right. Very interesting.
Yeah. So normally our strategy is, we buy land from our funds, And once we have the land for the construction, we go to the bank. And
Mm-hmm.
then as the construction progresses, they start releasing the payments,
Yeah.
and it's all interest only.
Yeah. Okay, great. Based on how much you've drawn.
Yeah, how much you
Yeah,
draw.
yeah.
Yeah.
Awesome. Perfect.
Okay. All right. And now you mentioned earlier you have switched your strategies from syndication to a fund model. Do you
Mm-hmm.
also do fund of funds? Like, do you work with other investors who are willing to invest in your in your property?
Yeah. So, true fund of funds, we don't usually work with them, and it's not
Okay.
because we don't want to. It's because typically what they want to do is, maybe they'll go out and raise $1 million, and in exchange for that, they'll want a piece of the carry interest in our
Hmm.
fund. We just, I mean, first of all, $1 million isn't enough to move the needle for us anymore. Number
Hmm.
one, and number two, I mean, we work hard. We're doing all the work. And so most fund to funds guys that approach us
Hmm.
want part of our carry interest. I never understood that, because they're raising money. I mean, it seems like their investors should pay them, but every time they talk to us, they want us to pay them, not their investors. So it doesn't usually work out.
Okay.
But that's the only reason. It's just, I don't know, if there was a fund to funds person out there that I mean, a 90-10 deal when all the fund manager did was raise the money. Seems like a good deal to me, right? It seems like a good payment. You haven't really done any of the work except raise the money
Raise the
and
money.
vet the sponsor. So I don't know. We just haven't, and that's why. But it doesn't mean we're not open to it.
Okay. All right. And with regards to building the investors' relationship, what
Mhm.
are the basic strategies that you implement? Let's say someone wants to get started in raising the fund. How
Mhm.
would you, what are your suggestions, step by step? What would you suggest them to?
Yeah, yeah. So first of all, you got to decide if you're going to do a 506B or 506C. We only do C's because we
Six.
market,
Yeah.
right? I mean,
Hmm.
I'm here on this podcast talking about our fund. I mean, that's
Yeah.
solicitation, right?
Yeah.
So we do a 506C. We only allow accredited investors. And if you're thinking about our training programs, the first thing that we do is educate you about the rules. I mean, that's the first thing you need. Secondly, we want to
Hmm.
make sure you have an SEC attorney. And the third thing we do is help. I mean, remember, we've already taught them how to underwrite. So they know how to do that. Now it's about how to talk to investors about your business plan, right? Because most
Yeah.
people, when they say, okay, let me go out and raise money, well, they throw spreadsheets up on PowerPoints and people are just like, they don't even know what they're looking at.
Yeah.
So we help them through that process and teach them how to properly, present their deal in a way that investors care, right? You
Hmm.
got to tell them what they need to know about, right? And most of the time, we teach a lot of fact finding, right? Like, I want to know what's your goals. What is your investment goals, right? If you're going to tell me that you need this money in about a year and a half for your kids' college, I'm going to be like, nah, not going to work, right?
Yeah.
We just want to make sure that we understand. And that's part of the process. And then usually the presentations kind of focus on what you need, right? Does our
Mhm.
investment do what you're trying to do? And if it's a match, great. If it's not, then we need to identify that and then, tell you this isn't the right thing for you. And that's what we tell people to do, right? A lot of people will just say, hey, I'll take any money. It doesn't matter. But you don't want to have that. This is not a liquid investment, as you know.
Yeah.
Once
And
you're
the
in,
edge,
you're in.
yeah. And as you mentioned, right, the educated investor is the best investor.
Oh,
Uh,
yeah,
they
absolutely.
they know exactly what they're getting into, and the
Hmm.
expectations are very clear on what
Yep.
to expect when, and uh, because I've seen sometimes, if the investors are not clear on the strategies that
Yeah.
you are implementing,
Yeah.
they might come back to you, or they
Yeah.
might ask you several different questions, which which will put you in a bad spot.
Yeah, no, that's exactly
Yeah,
right. Yeah, I mean, it's hard to build up enough trust to have an investor give
yeah,
you our minimum's $100,000. I mean, that's a lot of money.
yeah.
And so, we spend a lot of time and energy really, developing a relationship with each one of these investors. And it's my goal that that this is a long-term relationship, right? You don't want to be transactional about this. So you want long-term relationships, and you have to take the time to build the trust on the front end. That's the most important part about raising money, in my opinion,
Yeah.
right? Because and then if you deliver, they'll come back.
Yeah,
Just
absolutely.
deliver. Just do what you said you were going to do. There's most investors understand there's no guarantees here, but you can't fail all the time, or no one will give you any new money.
As long as you can deliver around, what you have promised,
Yeah.
plus or minus few here and there, that's
Yep.
okay. But as
Yeah.
long as you can deliver,
That's right.
they're going to come back.
And
And they're going to bring their friends also.
that is exactly what happens. Yeah.
Yeah.
Because they don't want to refer their friend in. Hey, I met this guy. You should invest with him, until they are like, okay, I've seen this guy. I know this guy. I've actually made money with this guy. Now they get more comfortable doing that.
Yeah.
And that's the way it should happen. I
Excellent.
think that's the right way to do it.
And what are the other main funnels, like, to attract the investors, that the funnels that you use?
Yeah, I mean, we use a lot of webinars, right?
Okay.
And so we have basically 2 webinars that we do free every month. One we call the Real Deal webinar, and that's basically an investor update. Like, we have one coming up I don't know when this will air, but in our next Wednesday. And that's, I'm going to talk about exactly what's going on in our portfolio. For example, we just had 2 properties get renewed for insurance. What happened with the rates? Did they go up? Did they go down? Like, real information. What's our leasing traffic? What's our occupancy like? Right. And it gives our investors a chance to come to these webinars that are free and ask any question they want. That's really, really important. And then so we usually do every other Wednesday. The other webinar that we do each month is called our Multifamily Workshop. And that's where we get into the weeds on some training issue, right? Some educational issue. And, whatever it is that we happen to be talking about that week, that session, they then will bring their questions about, oh, I don't understand how to do this, and when should I submit an LOI, and whatever questions they have, right? That's all free, and I try to answer every single question, so that they, my goal, I told you, my goal is for them to make $1 million. I mean, I have really changed their life if I can make that happen. And again, on the passive side, we want you to be informed, and if you're doing your own deals, we want you to be informed. And so those free, we have book downloads and everything on our website that help people figure some of this stuff out, right? They're all free. I wouldn't charge for them. Because again, I want people to get started and get comfortable.
Yeah. And talking about the passive investors, right? As you know, like there are so many different, I would say operators who would make the decks, present the decks. So for passive investors, what are the things that they need to take a look at in the numbers when they're presented with all the details? What are the specific things that they need to make sure before they invest with the operator?
Yeah. So before I get into the numbers, let me just say I have 4 rules I want them to follow. Number 1, they need to make sure that whoever they're investing with has experience. Duh. Absolutely. I mean, of course, duh. Yeah. But here's why. Did we know COVID was coming? No. Did we know hyperinflation was coming? No. Did we know the Fed was going to raise rates like they did? No. We didn't know any of this stuff, right? So the experience is important, because you need a management team that is going to run this business that you're investing in. They need to have experience and be qualified to figure out we don't know what's coming next, and you need a good management team. So experience. The next thing is track record. Now, of course, these are like, no kidding, Ken, really? But here's what's important about the track record. Yeah, we've done 19 deals, but here's the important part of that track record. We've turned 14 deals full cycle. So you can look on our website and you can see that we've sold 14 deals, and you can see the results. They're right on our website. They were fully vetted by Verivest, audited by them. So that track record of showing that you can make money is really important, and you should always look for that. Third thing they need to do is make sure that they're transparent, right? So before we put our returns on our website and all our deals, we hired somebody to come in and audit them. All 25, 26, 27 years of deals. It was brutal. Cost me a lot of money, but that's important. I wanted investors to be able to trust the numbers. And then how they communicate, right? You should be communicated with at least quarterly, with financials, P&L, balance sheet, rent
Hmm.
roll.
Yeah.
And if you have a question, they should be willing to answer your question, right? Part of the reason we do the real deal is so that you can come and ask any question you want. And I have to answer it. I mean, how am I not going to answer it, right? That's transparency. And the last one is you need to make sure that they put you first if you're the passive investor. That was a little harder, but you basically have to look at the PPM, the private placement memorandum, and see what the fees look like, right? A lot
Hmm.
of people do these deals, they syndications. There's 2, 3, 4% fees on the acquisition, same on the disposition,
Yeah.
3% asset management fee. And I mean, that's a lot of money off the top before the investor gets theirs, right? So in our case, we have a 1% acquisition fee, 1% disposition, 1% asset management fee. Like, that's pretty low, right? Why do I do that? Because I'm not here for the fees. We do an 80-20 split, and I know that if you do really well, guess what? I'm going to do well.
Yeah.
If you don't do well, I'm not going to do well, right? I'm not feeing it up, right? I can't make a lot of money and you not do well. That's not possible. So that's how you figure that last rule out, right? You got to make sure that they're putting you first. There's a
Hmm.
lot of tricks that people play, but you just have to look at the PPM. And so if you follow those 4 rules, it's really going to be helpful. There's no guarantees, right? You're still going to have a sponsor that might still screw up. But if you follow those 4 rules, every time people lose money, I look at those 4 rules and I say, okay, which one did they break? And usually it's at least one, maybe 2. Now, in terms of the numbers, I would say the most important thing for investors to do, passive investors to do, and this is weird, but a lot of people do this. They're afraid of offending the sponsor when they're on a call like this with them, right? You and I are talking, and they're afraid to ask the questions like, "Well, what happens if you die?" Well, that's a good question, but they don't want to
Yeah.
offend, right? They don't want to talk about it, right? What happens if this happens? Why is this that? Why do you think there's upside here? Help me understand. And they don't want to offend the sponsor. It's really a weird thing. I'm like, look, if I'm going to give you $100,000, I'm going to ask my questions. But a
Yeah,
lot of people
absolutely.
hesitate to do that. So drill down and ask those questions, and you'll know if the sponsor doesn't know what they're doing because they will not give you good, real answers. They'll give you high level answers that you're like, that was your answer. If it isn't satisfying, there's a reason for that, right? Keep drilling, and then you'll find out, okay, maybe they do or don't know what they're doing. But that's what I want passive investors to do. Ask the hard questions, because if the sponsor doesn't want to answer your hard question on the way in, what are they going to do if the deal's struggling? You're never going to
Yeah.
get an answer, right?
And yeah.
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 So that's what I want them to do.
Mhm.
Because I
And
don't
the
want them
ex
to lose money. I just don't want them to lose money. They don't have to invest with us, invest with whoever, but just find the good ones and try not to lose money, because everything changes when you lose money in this game.
Yeah. Okay. All right. So now, as you mentioned, right, you have 80-20 split LPGP,
We
right?
do. Yep.
LPGP. So that's on all on the back end. You don't take no management fees in between.
We
Of
have an
course,
asset management fee.
asset man
Yeah.
fees. Okay,
It's 1%. Yeah.
1%.
I've never seen anybody charge less than 1%.
Mhm. So one asset management, and then
And
final
one on
on
the
the disposition.
disposition. Yeah.
Yeah. Yeah.
I mean, I've never had an investor. We've got about 400 investors in our deals, about
Mhm.
45, 46 million bucks. Nobody said, "Oh, Ken, your fees are ridiculous." They just never said that, because they're
Yeah.
not, right?
Yeah, they're not. Yeah.
Yeah, when you get to 2 or 3% acquisition, 2 or 3, think about it, 2 or 3 on the acquisition, 2 or 3 on the disposition, 2 or 3 on I mean,
It
that's a lot
adds up.
of money.
It adds up. Yeah.
I mean, that's a lot of money then before you even get here. So,
All right. So now talking about the current situation, right? Just before a couple of days, stunning victory from Trump.
mhm.
As you know, what do you expect? Like any laws, regulations uh, that would be changed in favor of real estate investors? What are your take on it?
Yeah, I don't really know. I have really no clue what they're going to do. I mean, when you think about it, the guy in
Mhm.
the White House is a real estate guy. That seems like that should be a good thing for real estate people. I could be
Mhm.
wrong, but that's what it
Yeah.
seems like.
Mhm.
Um, what matters the most to us in multifamily is rates coming down. Right now,
Yeah.
where rates are, everything is locked up.
Yeah.
Sellers won't sell because cap rates are too high if they don't have to sell. Buyers can't meet the sellers. There's too big of a gap. It's all with interest rates. I see it happening in private equity as well.
Yeah.
Private equity who raises money from institutions. The institutions are fully invested. Nobody's exiting deals because they don't want to sell at those depressed prices.
Yeah.
So that whole system is jammed up, and it's all about interest rates. So if we
Mhm.
get the administration to lower interest rates, everything's going to be completely different in our
And
business.
and today, Fed announced like they decrease 25 basis point.
Yeah,
But the mortgage rate is not coming down. The Fed is decreasing the interest rate, but it's
Mhm.
not coming in sync. Like the mortgage rate is still higher.
Yeah.
Uh,
Well, the
uh,
good news, the 7 year did come down 11 basis points, so we're at about four and a quarter now.
yeah,
But I mean, Fed's coming down, rates are still high. Like that,
high.
we're still trying to figure that out. I think I
Yeah,
know why, but you know what, I don't really know. It's just one man's
yeah,
opinion. But we just need the rates to come down because there's too
yeah,
much, it's just locked up.
yeah.
It's just locked up and everybody's just waiting.
Mhm. And not only multifamily, everywhere, right? In
Yeah.
other commercial as well as residential, single family, everyone
Yeah.
is
That's why I
locked
said the
up due
whole
to
private
rates.
equity industry,
Yeah,
right? Companies that are being bought and sold, they
yeah,
operate the same concept, right? It's a multiple of cash flow. That's how real estate's bought.
yeah,
And they use debt, maybe not as much as we do, but they use debt. They rely on debt.
yeah,
And so when the multiple goes down, price goes down, they're like, "Oh, we're not selling now. We just
yeah.
waited longer and get a lot much better price."
Better
So
price. Yeah.
yeah, it's just the whole system's got to get unlocked. And
Mhm.
all it takes when the 7 year went down to like 380, the brokers in my world said they got flooded with BOV requests.
Mhm.
Well, all we need is 3.8, 3.7, 3.5. I mean, it's going to completely change. There's going to be a lot of stuff available to buy, a lot of good properties, because people have been holding them. They don't need to sell, right? They didn't
Yeah,
screw up their debt. They're good operators, and they're just like, okay, I'm going to wait for the market to come down. Why would they sell into a bad market? They won't unless they
yeah,
have to. So
absolutely. Yeah,
interest rates come down, everything's changing. Everything will change. Otherwise, the only thing that's going to get sold is stuff that has to get sold.
that's true. That's true.
Yeah.
All right. Ken, loving this conversation, but I also want to be mindful of your time. So before we move to the
Yeah.
final round of questions, is there anything else you'd like to tell to our listeners?
No, no, all I want them to do is take this seriously. This is a business. Make sure you do the work, learn, right? If you learn from
Yeah,
us, fantastic. If not, learn from somebody else. I mean, KRIPartners.com, go check us out and see if we're the right answer for you. But just make sure that whoever you learn this business from, they get into the details. It's the
yeah,
devil is in the details. Don't let anybody tell you it's not true because it is true. I live it every single day. And every single day, these details matter. I mean,
yeah.
hundreds of thousands of dollars are won or lost on any deal over just the stupidest little details. And that's why I want you to pay attention to them. So that's what I want your listeners to know. Just roll up your
Oh,
sleeves and do it.
good. Absolutely. And just do it. Just don't be, listening to podcasts, reading books. Just take action at one point of time.
That's right.
That's,
Yeah.
yeah.
Yep.
All right. Ken, let's move to the final round of questions. Are you ready?
I'm ready.
Okay. All right. So, which is the one book that you'll recommend to our listeners, which had a most impact on your life or on your business?
Yeah. Probably the biggest thing. I've read a ton of books. I mean, I
Mhm.
could list, we could be here for a half hour listing them. I won't do that to you. I would say the 10X rule is probably one of the most recent by Grant Cardone.
Grant Cardone. Yeah.
It's about just taking massive action. Like I
Mhm.
always used to think, okay, it'll take this much action to get something done. No, it's never enough. You just need to go crazy and take massive action. So that has been the biggest impact on all parts of my life, not just
All right.
business.
Okay. And what are your main source of information to learn and grow?
I mean, I'm a news junkie. I listen to CNBC a ton. I just learn as much as I can. I read. I'm into John Maxwell right now because he does a lot of leadership stuff.
Mhm.
All I'm trying to do is every component of my my ability to lead a company, I just try to whittle away at that. Right now it's John Maxwell. So, tomorrow it'll be something else. I don't know. But the more the more valuable you are, right? The better decisions you're going to make, hopefully.
Yeah,
And
yeah.
you'll make the thing that I always say, knowledge builds confidence. I mean, it really does.
It does.
Really does. I see people that the number one thing that stops people in multifamily is that they don't understand the numbers, and they know they don't really understand them. So they don't take action because they're scared they don't want to lose money. It's about knowledge. Learn this stuff. Your confidence will go through the roof, and then you'll be successful.
All right. What is the best business or investment advice you'd like to give to our listeners?
Yeah. I think I've kind of already said it. It's do the work. John Maxwell, I'm kind of into Maxwell right now. John Maxwell said, I heard him say this recently, they want to do what you do, but they don't want to do what you did. Think about that. They want what you got now, but they don't want to go through that whole journey that you want, right? Because all they do is they see that successful person and they think, it just happened like that. It's that whole thing, that do what they did that you have to do. Just do that. Just do that. Just don't take the easy way. Just roll it up, do the work, do what I did, do what successful people did, and you'll get there. I'm just telling you, it'll happen. It always does.
Yeah. It's the grind that behind the scenes, that counts.
Yeah. They think, oh my gosh, look at you. You're lucky. No, no luck there. The only luck I have is a whole lot of hard work.
Exactly. All right, Ken, before we part, how can Decoding Cash Flow listeners get in touch with you?
Yeah, thanks. KRIPartners.com. Go to our website. You're going to see where you can either go left toward the education side, right toward the passive investing side. I told you, most people do both. Really important. There's a ton of free stuff on our website. We have a free underwriting webinar. We have a bunch of books that can help you. I don't even charge for them. So KRIPartners.com. Go there because I want you to start to figure this thing out, because it has massively changed my life, and I see it massively changing people's lives every day. You want to do this. Just trust me on that one. So KRIPartners.com.
All right. I'm sure our listeners will go to the website to find the important thing, the educational things, and get in touch with you as needed. Ken, thanks a lot for coming on the show. It was a pleasure talking with you today.
Well, it was a pleasure to be here. Thank you so much for having me. And hopefully I see you again soon.
Yeah, we'll stay in touch. Thanks a lot.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.